Hey everybody, welcome to another Midas Letter Daily. I'm James West. My good friend and co-host Ed Mileski will be here a little bit later to talk to to take the audience questions. So we'll be answering those together, but I'm just going to lean right into today's show. And today on the show, I've got Grant Smith joining us. He's the CEO of Pond Technologies. And Pond Technologies is a great story. Stock's been really beat up. It's at 22 cents today. And they're going to raise $1 million at 20 cents. If you're accredited, you can participate in that private placement. Shoot me an email and I'll forward it to the company. And the company's, I've been following the company since early 2018. And there's a new CEO, which is Grant Smith. And they've they're trading at 2 times earnings. So what does that tell you? The thing is undervalued, basically trading like a shell. And that's unfortunate. But we're going to turn this story around, and I think that this is a entry-level opportunity for investors with good risk tolerance, but I think it's a no-brainer. When you hear the story, I think you'll agree, but feel free to write me and ask me more about it once we get going. Paul Brennan joins us. He's the CEO of NervGen Pharma Corp., company involved in treatments for spinal cord injury, nerve regeneration. Amazing story. Sounds like it's going to be a home run in the biotech sector. And then in the biotech sector, again, we've got Guido Baechler. He's the CEO of Mainz Biopharma, which is in the cancer testing space. And it's another, again, a really great story. And the stock's already been as high as $30, so could go back there pretty easily. It's always easier for a stock to go back to where it's been than for a stock to go where it's never been before. At least that's my sort of generalist view from 30 years in the market. If you like the show, you'll love our website. Visit us at www.midasletter.com for interviews with key CEOs, cannabis news, and to subscribe to our newsletter. So GMG is currently in the pilot plant mode. And so they do not have a commercial battery available for anything yet at this point. And so how long will it be before batteries will be available for solar backup systems? I would say that that's way down the product life cycle chain, or rather timeline. However, I don't know what their development plans are in that detail over such time. And for that, I would refer to the company. But I'm pretty sure they would say that they haven't really got that far yet. They're focused right now on coin cells, coin and pouch cells,
yes.
and that's what they're going to focus on. So we can't really answer that question, I'm afraid, Stephen.
All right.
Wow, that's an interesting question, Mark the Bank. That's a great question for a guy who calls himself Mark the Bank. Okay, so first, there's two parts to this answer. One is that as an investor, I don't actually, and this might sound a little bit cynical, callous, and irresponsible, but it's the truth. And the truth is that an investor should not care ever whether the company succeeds or not. As an investor, as a cold-blooded economist, what is the term? Hominous economist. Anyways, there's an expression for
Who are you talking to?
Somebody who is purely rational and coldly. You do not care whether the company succeeds. If you can make money, if you're a trader, if you can buy low and sell high, well, everything's a trade.
Right, except if you're a long-term investor.
That's still a trade.
I know, but you don't, in the short run, you didn't care if Amazon made money or not.
Right. Is the stock going to go up?
Well,
that's all you should care about. So if you can make money in something like a crypto, an NFT, or DeFi stock purely by doing a trade based on some event, then that's fine. But if you are going to invest for the long term, if you're investing on the fundamental thesis that this company's value is going to increase as they achieve
because they're going to sell more products, they're going to do this, they're going to do that.
They're going to put a mine into production.
Yeah,
exactly.
Yeah.
That's a different thing.
That's a different thing.
And that's a longer term investment. So, and it's okay to be both. It is okay to be both. A lot of people say, well, you can't be a short investor and be a long investor too.
Well, if you're going to, you have to be both.
Well, you can't. You don't have to be. You can
try,
be.
You want to try and score on defense once in a while. You just don't want to score on offense.
No, but I'm not going to try to short stocks because it's a way different game. It's a different mentality. It's a different. There's a lot of different metrics involved in the economics of it. So, I mean.
Yeah, Mark DeBank, he was asking about mentality.
Well, that's
a different mentality.
It's a different mentality.
Okay, the answer is it's a different mentality.
What is your mentality?
I don't have any mentality.
It's effective mentality.
You know what? Nobody knows how far it goes. Once it starts, the trend is your friend. Right now, we have higher interest rates, and we know that there's never been this much indebtedness that's going to start infecting that indebtedness. That's going to weigh like an anchor. My guess is it's going to get. If they keep raising, if they're going to raise 4 times or 5 times this year, I think they're going to unleash fury, and they may wish they would have rethought about their. They're caught between a rock and a hard spot. If they don't raise rates, we're going to have hyperinflation. If we have hyperinflation, the masses will storm Queen's Park. If they storm Queen's Park, they're going to lose their jobs. It's going to get crazy.
Possibly their lives.
Well, you know what? We don't want to talk about what happens in places like Argentina. But I think the rate for the 10-year yield in Argentina right now is about 40%.
Yeah.
40.
Holy tangent.
40. Why don't you put your money down there?
Well, because you're never going to collect on that.
Well, you'll collect on it, but it'll be worth. That's the problem.
Are you going to collect on it though? They're notorious for defaulting.
Their currency gets so deflated.
Yeah.
You get paid, but it's already worth less than.
So to bring it back to your question, Nazim, will the upcoming rate hikes solve the inflation crisis? Ed seems to think that it's you're damned if you do, damned if you don't.
You know, I remember back in the early 80s when the Fed chair, who was famous for tightening the screws, they raised rates. The 20-year yield back then got to 14.9 or 13.9, some crazy yield. It's 2% now. It's 2.5. You know, we're so far. It's such a different world. They're always screwing around with things, right?
Yeah. I think that the 4 rate hikes will not stem inflation. I think that the forces behind inflation, which is largely human sentiment. So if the Fed acknowledges that they've lost control of inflation through quantitative easing and by raising rates, if they signal that to the market's going to panic and flee to commodities, driving prices higher.
You know, there's a famous Canadian company, Canada Goose. They just came out with their earnings, and their revenues were higher, but they lost money. And it's about raising. Can they pass that price on to their consumer? If they can't, sales come down. If they pass on the price increase, less people are going to buy because it costs more.
Well, if you paid $500 for a Canada Goose jacket last year,
5,000,
and last year it was $500, and this year it's $700, you're not a buyer. You're going to say, I'm going to wait till it comes back down in price. But if it's been 5 years since you've bought a Canada Goose jacket and it was $500 5 years ago and now it's $700, then it's okay. So that's the thing about inflation is people will accept inflated prices over a longer time frame, but they will not accept short, sharp price rises. They will defer the expenditure, and that's where economic weakness develops as a result of inflation.
Let's see where the gas pump goes, because traditionally when that's a big transportation thing.
Yeah.
Yeah.
Well,
it's happened in England.
When I see $1.60, I'm thinking, well, I'm going to drive the car and park it in the driveway now because I can't afford to drive now.
I'll better walk.
Yeah. Anyways.
It kills demand. Anyway,
there's our answer, Nazim. Thank you for the question. The market does not like what they've learned about inflation. And I think that this really complicates things because we see that inflation is in place. And now it's a question of, well, can the Fed really afford not to raise interest rates and lose control of it even more?
And remember, when this inflation thing started, they're saying, oh, it's transitory. It's transitory. No more. When was the last time you heard transitory?
It's been changed. The word is now entrenched.
Entrenched. You know what? I was just going to say, damn it. I will say this. I've been a Detroit Lions fan forever. Matthew Stafford was a quarterback there and didn't have a great career. Did all right. Made a lot of money. He's now playing for the Los Angeles Rams, and they're in the Super Bowl. So I'm rooting for Matthew Stafford because I think I've suffered pain with him over the years. That's just a personal following Matthew Stafford, so I'm picking the Rams over Cincinnati.
And I don't have time to follow the football because I only follow the market. And so when it comes to sports betting versus the stock market, I'll put my bet on the stock market any day because that's where I live.
They bet on everything. That's another reason. That's another reason the whole thing is going down the shitter.
Because everybody's just betting.
Could you imagine cave people saying, "Hey, I'll bet on it. Bet you can't kill anything today." Like, how much? Why would I go on? I'll just make a bet.
Hey, bet you that guy looks left before he looks right.
You know what? When Homo sapiens stops creating an actual benefit, maybe it's time for them to say bye-bye, world. We need to bring another species in.
Hey, so the cockroaches are going to be gambling next.
And the ants. And the ants.
If you're enjoying the show, subscribe to Midas Letter on YouTube so you stay up to date on everything investment. But today, let's see, the main topic of interest here, let's go look at this chart. Right, okay, so here's the response. So the CPI number came out, and it was 0.6. 0.6 times 12 for the annualized rate is 7.2%. But the annual number came out, 1 year measurement of inflation is 7.5%, suggesting that inflation is increasing more aggressively than even the monthly rate. So what does this mean? Well, here's what it means for the Fed 10-year rate is it's already well over 2 points now. It means more expensive mortgages at a time when the moratorium on foreclosures in the U.S. housing market is expected to come to an end. And also coming at a time when the Fed has indicated that they're going to stop to withdraw stimulus. So let's take a look at the effect that's had on markets. So here's the S&P 500, looking big sell-off there on January 26th, now looking super choppy in here. And looks like it could go quite a bit lower. Now, so the expectation, the great moment we were all waiting for here is the Fed going to raise interest rates at the February 23 meeting? Are they going to wait till March? Are they going to raise it at 25 basis points at a time or 50 basis points at a time? Are they going to do 4 or 7 in the year? Are they going to do more? These are all factors. The Fed's only possible response to the rising inflation is to increase interest rates. So you can bet that if the CPI number continues to ratchet higher, despite the broadcast of the intention to raise rates, that the Fed is going to actually have to raise rates more aggressively than transmitted. And the net effect of this, combined with the withdrawal of stimulus, is going to be weaker technology share prices, and generally the stock market is likely to suffer greatly because most of the value in the stock market, don't forget, is driven by the top 5 tech companies, and those companies buy back stock is a fundamental methodology for driving their stocks higher. They use the leverage afforded by a super low interest rate to do that, and that becomes more expensive as interest rates rise. So the incentive to buy back stocks on the part of these big guys becomes less. Let's now take a look at the Dow Jones. Dow Jones also looking pretty weak in here. And the NASDAQ also looking weak. But let's go look at the futures. Okay, here's the E-mini Dow, also down. So the expectation is for this weakness to continue. And despite the signs of intervention, and when I say intervention, I mean, I don't care who sponsors them, but who's buying futures when the Fed has broadcast that they're going to raise interest rates and would reduce stimulus? Who is buying, who are buying these companies? What factor could make them go up beyond earnings? And the earnings have not been that spectacular. So I think it's intervention from the President's Working Group. And, the President's Working Group, if you don't know who they are, look at Wikipedia. The President's Working Group is comprised of the heads of the CFTC, the SEC, the banks, the banking system, etc. And so it's the creme de la creme of the financial agency, and they are tasked with stabilizing financial markets, which includes equity markets. And so the insinuation in the past has been that the president's working group actively supports the stock market through the purchase of securities. And they don't report what they do, and their actions are all secret. So you can't know, and so you can only speculate. And so it falls squarely into the category of conspiracy theory. But there you have it. I don't see how it's possible that anybody who's a real investor would be buying this stuff. Now here's the opposing argument. Let's assume that the smart money is saying, yeah, the Fed is never going to raise rates because they know they're going to kill the golden goose, which is the tech market. They're never going to stop printing money because the wealth effect is a direct result of the capital fabrication and the fractional banking that miraculously creates more money for distribution throughout the financial system. So maybe the bet is that the Fed is going to come back with stronger stimulus, even more stimulus, even lower rates, if that's even possible. I mean, with a 7.2% annualized inflation rate, any interest rate below 7% is below inflation. So, I mean, is that what it's going to take? And if you hearken back to the late 70s and 80s when inflation drove the Fed put the interest rate, I think it got as high as 18% in some cases in mortgages. That is the kiss of death for the housing industry. And never mind for the housing industry, that is the kiss of death for homeowners who are, significantly leveraged with a variable rate mortgage. Those mortgages are going to start to put a lot of people in the street if the Fed was to proceed with this broadcast plan of we're going to raise rates. Now, I don't see how they can. And maybe that's why, that's maybe where the positive energy in the stock market is coming from, is the smart money knows that no, the Fed is never going to actually raise rates. And no, they're not going to stop stimulating because they can't afford to. They cannot afford a wholesale riot in the marketplace, and that's likely what would happen. The bottom line is, in the immediate term, with the expectation for interest rates to rise and the expectation that stimulus is going to be incrementally withdrawn and the Fed is eventually going to sell a whole bunch of those treasuries off of its balance sheet to try to bring the size of the balance sheet down, well, that's just all good for commodities. Why? Because commodities remain undervalued, and with inflation, commodities are what drives inflation, because when the money loses confidence in the other asset classes, it goes to commodities. And so not just the precious metals, which is alternative to treasuries, but also the industrial metals. And so as you've seen, lithium, nobody needs a PhD to understand what is driving the price of lithium to increase by 5x in the last 12 months and looked poised to go much higher despite record production of lithium. And that is why one of the companies I'm going to be bringing to your attention this year is a direct lithium extraction technology out of the Stanford University that is the best contender. There's a lot of direct lithium stories out there. None of them have achieved economic commercial production. This one looks like it's going to. Write me if you want to hear more about that. Okay, so let's now turn our attention to Pond Technologies, a company that not only facilitates a significant reduction in emissions from industrial emitters, but provides a revenue stream to those companies and a financial incentive to install the technology. Here is Grant Smith. Grant Smith joins me now. He's the CEO of Pond Technologies Holdings, Inc., trades on the TSX Venture under the symbol POND, and trades in the United States under the symbol PNDHF. Grant, welcome.
Thank you. Good to be here.
Yeah, I should say welcome back, Grant, because we had former CEO Steve Martin on the show, and last time was 2019. There's been some changes at the company. Why don't you give us an overview of what has transpired in the last couple of years during this COVID crisis?
For sure. Well, yeah, we still have Steve around helping out as a technical advisor and advancing the tech in the lab. In March 2020, I became CEO with a revenue focus. And since then, we've continued to increase the tech. We've brought on 2 major customers where we've signed deals. And we're really excited about our pipeline and where we're headed.
Tell me about the technology that underlies Pond Technologies. What does the company actually do?
Sure. Well, we take CO2 from emissions, sources of CO2, like behind me, you can see the stack gas example. And that can be any heavy industry to a distillery, to a brewery, to a food grade facility, and we grow algae. 2 tons of CO2 grow 1 ton of algae.
What kind of industrial partners do you have that would use this system to grow algae?
Sure. Well, with a proof of life, we have a facility up and running. It's a pilot plant at St. Mary's Cement in St. Mary's, Ontario, just a few hours outside of Toronto. And there we're growing different species of algae off of cement gas. So that's kind of a dirty gas. They burn a lot of, nasties that go up that stack. But the NOx, the SOx, the CO2, the algae just breaks them all down and uses it as feed source. We also have a system at a cleaner facility, a natural gas power plant, and there we've been shown to grow human grade and even pharmaceutical type grade algae and proteins, and that's off natural gas from a power plant. That's just a CHP power plant. So we have 2 proof of life systems up and running where we can abate heavy industry CO2 and grow that algae.
So then does that qualify these industries for carbon credits?
Yes. So in this case, we're talking to a number of companies right now where the host emitter gets the carbon credits. We take their CO2 at a 2-to-1 ratio. And if we were to, say, remove 10,000 tons of CO2, we'd grow 5,000 tons of algae. Today, that algae is worth something. Years ago, algae was seen as biofuels. Now we have greater offtakes for the algae. Animal feed, human feed, and even pharmaceutical proteins that are grown within algae.
And so the products, what do you do with the algae?
So algae really is a super feed. So starting at sort of heavy industry, we can put algae into the land for soil reclamation. So think about the oil sands, tailings ponds. You can put tailings ponds into containers filled with algae. They break down the hydrocarbons. They put everything back to normal. Moving up the food chain, you have animal feed. So there's a real shortage of fish feed globally. Algae is the perfect ingredient for fish. They eat it in the ocean. Animal feed, chicken feed, cattle are reducing methane by adding algae to their diet. Dairy cattle are producing more milk by adding algae to their diet. The key here is we're also reducing arable land farming because the way that we can produce this algae, we're not reliant on the sun or anything. We've got basically vertical farms where we have bioreactors inside, and we're growing algae 24/7. So the LED, the technology, it's all patented, and it's around CO2, light, water, and we grow that algae.
So an industrial major emitter can install one of your systems and then make money while they issue carbon credits, reduce their CO2 footprint, and produce a feed byproduct.
Correct. And it can be very valuable in the fact that I'd say even 5 years ago, the market for algae was sort of unknown. So along comes Beyond Meat and the Impossible Burger and all these new vegan food companies. They all have a need for a reliable, sustainable source of vegetable protein. That's algae. We're part of that supply chain. And we're not reliant on the weather. And, you look in Manitoba, severe droughts or severe floods, there's always problems. Just ask a farmer. We've removed all those elements. And with our clean green system, we're really a clean tech and a food tech because we can grow these algae that contain ingredients that have high dollar value.
How does the economics work for an emitter? Like, do you have an example that you can describe? You mentioned a natural gas burning power plant.
Sure, yeah. I mean, Markham District's a great supporter of Pond. They're owned by the town of Markham. And what we're doing with Markham District Energy is we're taking their CO2 and we have a pilot plant on site and we've been able to grow different strains of algae. So this is a real proof of life. And what we would do there is then take that algae and sample our clients with it. So we're trying to find partners similar to that. It could be a distillery, it could be a brewery, could be other sources of just clean CO2, and we would grow algae that then has a home. So algae contains 66% protein. We can extract and concentrate that protein. That goes into the Impossible Burger. Algae contains omega-3, so you think fish oil. We can actually provide vegan fish oil for customers like Jameson and Natural Factors and Nestle and all these wellness companies without taking another fish out of the ocean. And we can produce different extracts and antioxidants like our astaxanthin. We have our own plant up and running in Vancouver where we produce a red algae, and that's a wellness product that you can find on store shelves or buy it off of our website.
Let me get this straight. So industrial emitters can now make more money putting out by reducing their CO2 than they can by just letting the CO2 continue as it is. So then at what point does the government mandate that you must reduce your CO2 if you can use the methane and the greenhouse gases as inputs to a value-added food product?
That's a good question. I mean, we're in talks with the government. We've had many high-level discussions. We've worked with, OCE and FedDev and a number of BDC, and we're talking to many groups, because our real business model is this. We've been able to have a license fee up front. We've signed 2 deals, as I mentioned, in the past 6 months. So there's a company in the UK. They're called Associated British Foods. ABF is the ticker, $15 billion market cap. They have food plants in 53 countries around the world. We signed a deal with their animal feed division called AB Agriculture, where we've received a license fee up front, which is greater than $1 million Canadian. We have an agreement with them to build a pilot plant off of their sugar factory. So we will be taking CO2 that's going up their sugar stack. Think of Red Pass Sugar downtown Toronto, that idea, nice big facility. We're going to grow algae off that facility, and they're going to put that algae into all of their animal feed formulations. So this was a really big, significant player, because first they chose algae and then they chose pond. And we're trying to emulate that model. We have a full pipeline, our phone's ringing, and we have a number of other companies that are seeing what we're doing with Associated British Foods and their AB Agricultural Division. And that's where we're really excited about where pond's headed.
So 2022, would you consider this an inflection point year for the company in terms of revenue? And what about profitability?
Great. Internally, we call it Pond 2.0, because in late 2021, Q4, we signed those deals. The other one is with an unnamed oil and gas major in Canada. They wish to be unnamed at this time. They gave us a little, I'll call it a petri dish of algae, and they said, we can't grow this. Can you grow it? We grew it at scale. What that protein was, it was the COVID SARS spike 2 protein in algae. So we have grown sustainably and at scale here at Pond. We've been able to grow that protein. That protein will be used in diagnostic test kits, where you can get an instant 99.9% accurate blood test. So think of, an oil rig or an operation like up in Fort Mac, and people go in and out of those facilities or areas. They want to keep their staff safe. So that's where this project came from. But you can imagine where the discussions are now leading to, because this group is realizing that we can provide, algae for tailings ponds cleanup, life in soil back into that dead cake after they squeeze the land. They need to make that land better. Algae can provide all of those solutions. So we have a really interesting unnamed partner, and this has explosive potential for us as well.
Wow, that's fantastic, Grant. We're going to leave it there for now, because I'm going to come back to you soon.
Absolutely. Thank you very much.
You bet. Bye for now. Yeah, so look at that chart. That's Pond Technologies, and as I said, it's been beat up, and they're doing a private placement down here at 20 cents. So a lot of that money is going to go towards marketing the results that the company has achieved. They're trading at roughly 2 times revenue, and that is just crazy. Crazy. It trades like a shell. So this company is one that I believe is going to become, I have no interest in this company right now. I don't own any stock. I have no options. I contacted the company. I had them on last in 2019, and I contacted the company and said, you guys are undervalued, and you need to be doing some marketing the right way to bring what you guys have accomplished to the... Anyway, so that's the conversation I'm having with them. So I might be conflicted down the road, but hard to say at this point. At this point, I am not. Anyways, next up, Paul Brennan joins us, and he is the CEO of NervGen Pharma Corp. My next guest is Paul Brennan. He's the CEO of NervGen Pharma Corp, trading on the TSX Venture under the symbol NGEN and trading in the United States under the symbol NGENF. Paul, welcome.
Thanks very much.
Paul, can we start with an overview? What is the business of NervGen Pharma?
So NervGen's a biotech company, and we're developing products in the neuroscience space, predominantly for patients that have nerve injury, either nerve injury as a result of sort of a trauma, such as spinal cord injury, or nerve injury as a result of disease like neurodegenerative diseases such as multiple sclerosis or Alzheimer's disease.
So what is the status of your products then? Are they in trials? Are they in an FDA process?
Yeah, we're in clinical trials right now. We're in what's called phase 1 clinical trials, which is in healthy volunteers. So we've gone through FDA review. We're actually conducting the trials in Australia. We're right in the middle of that at the moment.
What are the sort of addressable market for this product?
It's huge. So it's really anytime there's damage to the nervous system. So you think about all the people that have Alzheimer's disease or multiple sclerosis. Those are the really large markets, but things such as concussion or spinal cord injury or stroke. So the addressable market is, just if you take Alzheimer's as an example, there's 6 million patients in the United States with Alzheimer's. And the most recently approved product, Biomed, had an initial price of about $50,000 a year. And that's the price you would expect for something that's effective. They had to knock the price in half because they're marginally effective. But for an effective product, $50,000 a year, 6 million patients, that's a $300 billion potential. And to put that in perspective, if you were only to take 10% of that, you'd have a $30 billion product. And in 2020, the world's largest pharmaceutical product was Humira at $20 billion. So that would become one of the world's largest products overnight.
Are there any major pharmaceutical partners involved in this?
No, this is the great thing about us. We don't have a partner. So partners are a good and a bad. When you partner, you have to give up considerable value to your asset. And so you really cut the value of that asset in half or a third when you partner, although you do sometimes get cash in return. For us, the issue of partnership is, when are you going to get the best value in return for a partnership? And that will come once we translate our great results that we've seen preclinically into the clinic. And you'll see a huge step in value and desire for pharma companies to partner us or just acquire the company.
And I'm assuming that there's a pretty substantial intellectual property component to this whole proposition?
Yeah, our lead product's really well covered by IP. We have the most important composition of matter patents, and they go out until late 30s. So we're well covered.
Great. Okay, so how did you come about this company? How did you start it? What was the sort of path that led you here?
There's two lines to the story. One comes from the scientist, Dr. Jerry Silver, who is the founder of the technology. And he was really interested in understanding why the nervous system doesn't repair itself. But if you cut your fingers, they'll repair themselves. If you cut a peripheral nerve, it will repair itself. But if you damage your nervous system, the brain or the spinal cord injury, it doesn't repair itself. And so he wanted to know why that was happening. And he focused on spinal cord injury because in spinal cord injury, you have a huge scar that forms. And they knew that it was the scar that was trapping neurons and stopping neurons from growing. And so we focused on that scar to understand why the nervous system couldn't repair itself, and became quite successful in doing studies in spinal cord injury. So that was Dr. Silver and his focus on spinal cord injury. On the other hand, we had Dr. Harold Punnett, who is a dentist based here in Vancouver in Langley, BC. And unfortunately, his daughter-in-law got into a pretty tragic accident. She was in her late 20s, had 3 young kids, was on a construction site, fell, and became a paraplegic, which had Harold become distraught. So he started to look for what was out there, what could be used to help his daughter-in-law. There's nothing currently right now approved in the clinic to treat spinal cord injury patients, either when they have their injury or afterwards to help recover. And there's really, the stuff in the clinic isn't that inspiring. So he started to look at what was preclinical and found the work from Dr. Silver. Now, Harold was part of a venture capital group, or it's not a venture capital group, but an angel investor group, pitched the idea of taking Dr. Silver's technology into a business. Took them 2 years to get it out of the university, but eventually they were able to form NervGen. And what's really interesting here is, although Dr. Silver's work was initially focused on spinal cord injury, and Harold's interest was initially focused on spinal cord injury, this technology is not a spinal cord injury technology. It's a technology anytime there's injury to the nervous system. So the potential here is well beyond spinal cord injury. But what was key to this is because Silver was focused on spinal cord and Harold was focused on spinal cord. It allowed us to discover this technology, get it into a smaller company before really the broad potential was known.
Wow, that's amazing. So you are doing a phase 1 trial now. And so what is the timeline until this treatment might be widely available?
So that's a good question. It's a bit of a how long is a piece of string, because it depends on what the results we get in our phase 2 trials. So the phase 1 trials will wrap up mid-year, and then we'll go to the FDA to start our phase 2 trials. And we're going to do our phase 2 trials in spinal cord injury, multiple sclerosis, and Alzheimer's. And depending on those will read out, the initial results will read out in 2023, 2024, depending on the indication. Depending on the results that we get, will influence how quickly we get to the market. So for instance, in spinal cord injury, if we even get half of what we're seeing in the animal models, it'll be a breakthrough. And we'll get to the market really quickly. We'll probably have to do one more study, and then we'll be on the market. So you can see ourselves getting results in 2023, doing a confirmatory study that could take anywhere from 12 to 24 months, and then being on the market shortly after that.
Oh, that's quite interesting. Normally, that's sort of a conventional wisdom around the street that to get an FDA approval for a product takes $1 billion in 10 years. So you're clearly kind of abbreviating that process. Are you also doing it more economically?
Yeah, that's a good question. We are actually. I mean, being so we're quite small as a company. We're 11 employees. We don't have a desire to be 3,000 employees, so we're quite conscious about our overhead. Operating in Canada helps in terms of cost containment. We don't have a large infrastructure, so we're putting all the money into the clinical trials. And then when you're doing trials and things like spinal cord injury, then you're not spending that $1 billion because you're studying fewer patients. Alzheimer's ultimately, if we're going to go to a full program, it depends again upon the results we have. In the Alzheimer's, if we have marked response in patients, then it's going to be fewer patients that we need to study because we'll offer something, and getting access to funds won't be difficult. If it's what you see in the bio world is the products that are being developed have really marginal responses, and so you have to study thousands of patients.
What is the current sort of approach to treating spinal cord injuries, and does it involve any sort of nerve regeneration?
No, currently there's nothing to repair the nervous system for spinal cord injury, or actually any nervous system injury. There's no approved products that have nervous system repair. So patient has a spinal cord injury, taken to the hospital. What the doctors try and do is stabilize the patient and repair the broken bones by surgically stabilize the spinal cord. And then after that, it's really rehab. And in some cases, electrostimulation, which helps restore some of their function. But there's no pharmaceutical therapy right now. And patients aren't really getting over the hump. Electrostims are really promising and interesting therapy where some patients are able to regain some movement, but it's really, patients seem to be getting some improvements, but not the amount of improvement they'd like to see.
Right. Okay, well, we'll leave it there for now, Paul. That's a fantastic story. I'm really intrigued with this. So we're going to have you back in due course, and congratulations on your success thus far, and we'll keep an eye on the story and have you back in a short period of time.
Well, thanks very much, and I'd love to come back.
You bet. Thank you. Bye for now. So as I said, another great story. Stock has come back from quite a sell-off, and looks like it's poised to go higher. But again, these companies in the biotech space, their success and their investment performance is largely subject to regulatory approval of their products, and so that's what you got to keep an eye on here. But Sounds like a great story to me. Again, Dr. Mark Swain brought this to our attention. He's got a great newsletter. You should go Google him, check him out. He's a doctor and he knows his biotech stuff, so we look to him for some of this intel. Next up is another Dr. Mark Swain introducee to our platform, and Guido Baechler is the CEO of Mainz Biopharma, and here he is. My next guest is Guido Baechler. He's the CEO of Mainz Biomed, trades on NASDAQ under the symbol MYNZ. Good morning, Guido. How are you?
Good morning, James. I'm very good. How are you?
Great, thanks very much. Guido, tell us about the business of Mainz Biomed.
Yes, so Mainz Biomed is a diagnostic company focused on developing molecular tests for early detection of cancer. One of our lead tests is a test called ColoAlert, which is focusing on early detection of colorectal cancer.
What stage of development is your pipeline at this point?
So our ColoAlert test is actually CE marked and approved for sale in Europe. We're commercializing it already in Europe, and we are in the process of also starting to work with the FDA to get the product approved in the US.
I see. And what is the sort of addressable market size? How prevalent is this form of cancer?
So the market size is very significant. When you look at just the U.S. alone, it's a market size for us is roughly about $4 to $5 billion. There is a company called Exact Sciences out as well, who is ahead of the game. They're having about $1 billion revenue in the U.S. And based on their feedback, it's less than 5% of the market. So the colorectal cancer screening market is very significant because of some guidelines, recent guidelines as well, that everybody above age 45 should be tested very regularly. So you can imagine we're talking about millions of people that should be tested every year.
Yeah, the health system in Ontario where I live, they automatically send out a test kit to anybody who's over the age of 50. And so I think they do it every 5 years. I remember just getting a notice that it's time for me again. So, I mean, colorectal cancer, what are the typical sort of characteristics of it relative to other cancers?
So I think some of the main characteristics is that, first of all, James, colorectal cancer is one of the main killers of cancer, in the world, right? So it is, I believe, the second leading cancer death in the United States. And it doesn't have to be that way. I think that's why we're doing what we're doing, because, a lot of people, again, you mentioned before, you get your kid at home, and most people don't do the test. And the test that's been shipped out is okay, but it's not great because it's missing a lot of cases. And so, when you look at colorectal cancer, if it's detected early, right, because it's often diagnosis when you have stool, you have abdominal pains, and you have blood in your stool, but then it's often already too late. So you do want to come in earlier, and our test is actually designed in a way to pick up, cancer at an earlier stage, and being able to then, eliminate late stage cancer, because the survival rate is significantly high if you detect the cancer early. Again, it's like a pancreatic cancer, for example, is one it's almost always deadly because it's identified so late. Colorectal cancer can be detected much earlier, and as a result, you increase, the survival rate significantly.
So then, how soon until the product is approved in the United States and Canada?
So we're starting with the FDA discussion this year, and we're planning to enroll the study this year, depending on the feedback. So it will be, probably at least 3 years out before the product is available in the US. But again, the important part, James, is that the product is already available, commercializing in Europe. We're expanding it into, we started off in Germany, where Mainz is based, in the beautiful city of Mainz outside of Frankfurt.
Wow.
We're actually in a similar facility of BioNTech, which many of your audience probably very familiar with the Pfizer with the vaccine that was developed. And so we're actually commercializing it in Germany. We're expanding outside of Europe, potential Middle East and Asia, while we're getting ready, to performing the large study that's required for the FDA.
What other products are you developing?
So the next product that we have in the pipeline is pancreatic cancer. which is going to be a very similar concept of what we're having today with Colo Alert. And I think there's one point I do want to highlight, James, with our product. Like you mentioned before, you get a product shipped at home. We're doing the same thing. So our collection kit is very, very simple. So we send it to you at home. You take a few samples of stool, send it in, put it in an envelope, put it back into the mail, and you get the test results. So it's extremely easy done. And what's also important is it's from a turnaround time. It allows us to, our product is able to be performed in any laboratories, and I think that's a really important part of our story, which I like the audience to really understand. The current market leader in colorectal cancer in the United States, Exact Sciences, they have a centralized laboratory where they send kits all around the world, all around the US. The test is not available outside of the US. And basically then patients have to send the kit back into one central lab. And so our approach is different. So we want to work. We're able to actually sell kits to laboratories like large laboratories like LabCorp and Quest and Arup and Mayo, and we'll provide the kits to them, and then they can actually send it to their physicians and their patients. So it's a very efficient way to actually, provide the screening, the colorectal screening tool to a larger population rather than doing it by yourself. So that business model, James, is actually really, really important, an important differentiator what we're doing compared to, let's say, Exact Sciences.
Mm-hmm. Oh, so then you really wouldn't need necessarily to get approval in Canada. So, for example, if I wanted to take the test, would it be possible for me then just to order a test directly from your offices in Germany?
No, we would have to go through the Canadian approval process, which we're planning to do as well, James.
Okay.
Absolutely. This is one thing that we will look as well. Again, the company went public recently. We're expanding, our operational reach, our commercial reach. Canada is certainly also a place that we want to explore. And there's certainly a required, approval from the Canadian authority to be able to test you since you live in Canada.
Right. So then I guess it's pretty obvious that the compelling logic for getting tested early is that you have a better chance of surviving the disease, correct?
That's correct, yeah. That's exactly right. And that's the main passion of Mainz Biomed. It really is providing to all of us, right? Because we all know somebody that has, a family member, friends, neighbors that actually died of cancer, and in almost all cases, the survival rate would have been significantly higher if that cancer would have been detected earlier. And so that's really the main story, James. It's all about developing those specific, tests, and one thing is important, right? Our test is a simple PCR test, which is, 3 years ago, if I would have asked you what PCR is, you probably would have said, what are you talking about? But now with COVID, everybody understands that PCR is a very standard technology that, is very sensitive and can detect, very, very small genetic variations or genes of viruses, or in our case, cancer cells, to basically help you, get into the pipeline earlier on and making sure you get treated. In our case, when our test is positive, what you would do then, you would do a colonoscopy. And the colonoscopy is still the gold standard to really then help you. It will remove, cancerous cells. And basically, with our desire to even prevent cancer from happening, because some of the tests that we're working on is also helping to even detect lesions in your abdomen that are actually potentially cancerous. But before they get cancerous, you can remove them already. So our goal really is to move ahead and develop tests that prevent cancer from happening in the first place. And that's the colorectal cancer is a very nice way to be able to do this, because we have access to that tests to fix those issues.
Okay, Guido, well, let's leave it there for now. I'm going to come back to you in due course, and I look forward to actually using your product in Canada as soon as it's available.
Super.
Yeah.
Thank you, James. Thanks for having me on your show. Appreciate it.
You bet. We'll have you back soon. Thank you very much, Guido.
Take care. Bye-bye.
Bye-bye. All right, so another great story. But look at that chart. This thing's already been at 30 bucks once, and so when you can buy this stuff in the United States, it might return to those levels. Anyways, great story. We're going to have Guido back. He's a gentleman and a scholar, evidently, and we'll talk to him some more in due course. Now, the other thing I wanted to bring to your attention is my sponsor, the sponsor of our show. One of our sponsors is Voxtur Analytics, and Voxtur put out a press release on February 9th where they said they applaud the decision by Fannie Mae and Freddie Mac to allow digital appraisals. So one of the main revenue generators in Voxtur's business is the digital appraisal platform ANOW, which they acquired last year. ANOW currently provides up to 70% of the appraisals conducted by United Wholesale Mortgage, who is the 6th largest wholesale mortgage provider in the United States. With this approval, published by Fannie Mae and Freddie Mac, their business is set to explode just on the desktop appraisals. But here's the other thing. If Fannie Mae and Freddie Mac are going to allow digital appraisals, then what other digitization of the real estate transactional universe might they be looking at? Oh, like maybe all of them? And this is why Voxtur is poised to overtake all competitors, is because they have the most robust set of tools and, more importantly, the data to drive those tools, not just in appraisals, but across the whole gamut of the real estate transactional universe. Again, I have an option on 1 million shares at $1.15 in partnership with my coworkers. So if the stock goes up, we stand to win. So you should take that into consideration when you listen to what I'm saying, because obviously I'm very bullish on the company, because this company could make us very wealthy in 2022. But don't listen to me. Go and talk to the other people out there. This company, I'm telling you, 2022, it's going to be crazy for Voxtur, regardless of what the mortgage does. Now, here's the great thing about Voxtur. If the 1.2 million homes that are currently in some form of forbearance right now, in terms of the moratorium on disclosures and that's in place, if that ends and suddenly there's a flood of homes on the market that are going to be foreclosed upon, well, guess what company is going to be seeing a big jump in their business? That's right, it's going to be Voxtur. And if the opposite is true, if the stimulus does not get withdrawn and is in fact doubled down upon, and if the interest rates actually are not raised after all, then the housing market's going to take off again, and guess who's going to be the beneficiary of that? Right, Voxtur. So we're going to have Jim Albertelli on next week to talk about this for you. But this is huge. This is a huge development for the company. So yeah, just incredible. Anyways, that is my show for today. I'm not even going to talk about Bitcoin today. But that's the show for today. Thanks for watching, and send me an email, will you? I love to hear from the audience, and tell me what you think and what you'd like to see as guests, and ask me anything, always. Bye for now.